Hey everyone, welcome back to another episode. Today, we're diving into the order blocks. Order blocks are considered interesting areas to execute trading opportunities, but do you know why some of the order blocks work perfectly fine while others get ignored by the market? To answer this question, please stay with me. So, what exactly is an order block? Let's start with the basics. Order blocks are essentially the last candle that creates inefficiency in the market. This is where we believe big decisions are made by institutional players. In a bearish scenario, an order block is the area of the last bullish candle before a sharp drop in price. This drop usually creates a valid break in market structure. In a bullish scenario, it's the area of the last bearish candle before a significant upward movement that leads to a bullish break in structure. Order blocks can appear at the beginning of a strong move or even during the middle of a trend. They're often marked by a candle that stands out. Sometimes it's the same color as the trend, and sometimes it's the opposite. The color of the candle in an order block does no matter. So, if we want to proceed according to the definition, the last bearish candle before a strong bullish movement, but in this example we didn't have a strong bullish movement after a bearish candle here. Note that the bullish candles are weak. So, we consider the last weak bullish candle before a strong bullish candle as the order block. Keep in mind, to identify the supply and demand area, we consider the entire zone, but for the order block, we only consider that specific candle. The idea behind these zones is that they represent areas where a lot of buy or sell orders have been executed. Traders often see these as potential reversal points, where the price might change direction. By using these zones in our strategy, we can take advantage of the high likelihood of price reversals. Order blocks are considered interesting areas to execute trading opportunities, but do you know why some of the order blocks work perfectly fine while others get ignored by the market? To answer this question, let's talk about how to identify valid order block. Here are some essential criteria to consider. To identify a valid order block, we follow 5 key rules. Number 1. Come off a HTF-PD array. Everything should be analyzed in the context of the higher time frame or HTF. When trading with order blocks, it's important to align your time frames. Ensure that your lower time frame order blocks fit within the overall bias of your higher time frame analysis. The order block must be coming off of a previous PD array. Instead of trading any order block you see on the lower time frame, look at previous PD arrays like FVGs and trade the order blocks that form off of those FVGs. Number 2 is imbalance or FVG. There should be an imbalance or inefficiency left behind near the order block area. If there's no proper imbalance, the order block isn't valid. So, when the price makes a sharp move after an order block, it leaves behind an imbalance and forms a fair value gap. The price is kind of obligated to create balance within these imbalance zones and come back to fill those empty areas. Think of it like this: an order block itself already has an incentive for the price to return to that area. Now, if there's an imbalance there too, it's like the incentive for the price to come back is doubled. We all know how painful it feels when our SL gets snipped and price reverses and moves in our favor. I want to sharing one simple but very effective way to prevent order block traps. I have noticed, after months of studying price, that most order blocks that fail usually have a fair value gap right above or below them. According to the hierarchy of PD arrays, price would violate the order block and react from the fair value gap instead. This happens most of the time, and understanding this will definitely help you avoid unnecessary losses trading order blocks. Number 3 is a break of structure. A high-quality order block should lead to a break of structure or a change of character in the market. This indicates whether the market will continue in its direction or reverse. Another factor for valid order block is liquidity sweep. The price must take out or sweep the liquidity above or below the previous candle. If an order block sweeps liquidity below equal lows, or above equal highs, it's a strong signal for future movement. We give this kind of valid order block because it's higher probability. When we notice a lot of liquidity building up below certain levels, along with gaps and nearby order blocks, it's a strong signal. The price often moves to grab that liquidity, fill the gap, and then continue in the intended direction. For example, if there's a valid order block right below a liquidity zone, the price may break through the liquidity level, fill the gap, and then push higher once it taps into the second order block. Here's another example. Imagine there's a valid order block with clear gaps, a break of structure, and liquidity gathered below equal lows. If the price breaks below a higher low, some traders might see it as a change of character. But if we look closely, we might notice a gap and another valid order block just below. This could actually be a liquidity grab, meaning the market is still bullish. Number 5 is unmitigated order blocks. Order blocks are one-time use. Once they've been mitigated, touched by the price, they're no longer considered valid for future trades. We look for trades the first time the price touches the order block zone. Let's look at an example together on the Nasdaq chart. Well, the price is in an uptrend and has created a break of structure. To enter, we need to look for liquidity to sweep, a fair value gap, and a valid order block. We identify the liquidity zone and see that there is a strong FVG below this zone, which has an order block underneath it. So, we wait for the price to react to this zone and enter to buy with order. These 5 steps can help you find order blocks with a high probability of holding, and allow you to trade off of them with confidence that you have done enough to put the odds in your favor. This schematic image shows the necessary conditions for entering on an order block. Of course, besides technical factors, there are other elements that are important, such as the timing of order blocks and trading sessions. For instance, order blocks created during the Asian session are often less reliable and tend to be invalidated. Additionally, on Mondays, which mark the beginning of the trading week, or Fridays, the last trading day of the week, the credibility of order blocks tends to decrease due to lower liquidity. I've shared everything I know about order blocks with you. If you found this video helpful, don't forget to hit that like button and subscribe to our channel for more ICT insights. Let us know in the comments what topics you'd like us to cover next. We love hearing from you. Thanks for watching, ICT traders. Until next time, trade smart and stay disciplined.